Joining us right now to talk about all of this on the Squawk Newsline is Mohamed El-Erian. He is Chief Economic Advisor at Allianz. He also penned an op-ed in the Financial Times over the weekend on that topic. The piece is entitled, "Coronavirus Should Snap Investors Out of the Buy the Dip Mentality." I guess, Mohamed, that suggests that you think things are going to get worse before we get any sort of control on this situation.
I do, Becky, and this is different from what I've thought for a long time. For a long time, I thought that the market sentiment was so strong that we could overcome a mounting list of economic uncertainty. But the coronavirus is different. It is big. It's going to paralyze China. It's going to cascade throughout the global economy. And importantly, it cannot be countered, as Michelle just noted, by central bank policies. So I think we should pay more attention to this, and we should try and resist our inclination to buy the dip.
Mohamed, your big concern on this is that what we're hearing now, that these shutdowns will take place to February 9th, I guess, is not going to be the case. We're going to have to step back and wait to see what happens and then assess from there?
Yes, it paralyzes economic confidence. So how often do you get a shock that affects the demand and the supply side, that disrupts domestic and international activities, that derails the service sector at a time when the manufacturing sector is still weak? And all this in the context of fragilities in the global economy. So I do worry about this. This one is different. It is not the disruption to Saudi oil production in September. It is not the missile attack that the U.S. carried out on an Iranian general. This is a fundamental shock to economic growth in China.
Mohamed, I want to just ask you how we're supposed to process, where I was talking just earlier about the hard data. We're going to get a lot of data this week. The jobs number comes out. We have ISM at 10 o'clock today. This is data that the market...
It's all outdated.
Well, that's only the first part of my question, right? Is we get a lot of data this week. That's outdated. And then we're supposed to look through the first quarter data and discount that from the Boeing shutoff or shutdown. And then, I mean, when do we go back and say, here's the true state of the economy? I think what you're saying, Mohamed, among the things you're saying is it's just too much for the market to discount.
Yeah, I mean, put one phrase in your head, Steve, if I may, which is accelerating sudden stop dynamics. We know it well on the financial sector. That's what hit us in 2008. We don't often see it on the economic side. That is what's happening. It's increasingly a sudden stop to economic activity in China. And it comes in the context of earnings haven't been good. The data on the U.S., I don't worry about the backward-looking data in the U.S., but it does come in the context of weak European data. Already, we only had economic growth of 1.2% in 2019. For me, that's very close to stall speed. So look at the effects first and foremost showing in China. That data is going to pick it up quickly. Then in emerging Asia, then in Europe, and it'll come to us in a much smaller scale, and it'll come to us much later than elsewhere. So it's going to take a little bit of time to play out in the U.S.
Mohamed, you kind of went where I was going with Steve. So the central bank in China is, injecting liquidity, and bottom line, is that actually going to help when just people aren't willing to go outside their door? We had a conversation earlier in the show where the general thinking was, central banks are accommodative, so generally speaking, the market's still going to go up from here. But you're suggesting that central banks can't handle this issue in particular, and that's not necessarily going to work this time around.
Yeah, I mean, the playbook has worked extremely well, Michelle, and it's one that I've deployed, which is rely on central bank injection because the marketplace believes that liquidity can decouple us from fundamentals for a very long time. So that's the playbook, and you see it again today. The immediate reaction is to price in a cut. The immediate reaction of China is to inject over 170 billion. So everybody's been conditioned to behave this way. But it assumes that the shock is temporary, containable, and reversible. And those three phrases are very hard to associate with the coronavirus. That's why I think that the big risk is that we may finally get to the point where central banks are shown to be ineffective, if not counterproductive in Europe. And that's what I worry about.
Yikes. Mohamed, thank you. I'd love to see you in studio again soon, but we do appreciate your time this morning.